We are covering the promissory note for the national portion of the real estate exam. In the world of real estate finance, the promissory note is perhaps the most significant document because it represents the actual evidence of the debt. On your exam, you will likely encounter questions that test your ability to distinguish between the note and the security instrument, which is usually a mortgage or a deed of trust. You must remember that the promissory note is the borrower's written unconditional promise to repay a specific sum of money to the lender under agreed-upon terms. It is the legal contract that creates the personal liability for the borrower. When you sign a promissory note, you are essentially saying that you personally owe this money, regardless of what happens to the property. This is a critical distinction because the security instrument, like a mortgage, only pledges the property as collateral. One of the most common exam traps involves the essential elements of the note. A valid promissory note must include the principal amount of the loan, the interest rate being charged, and the specific payment schedule, including the maturity date. It must also be signed by the borrower. A trick question might ask if the lender needs to sign the note. The answer is no. Only the maker or borrower signs it because they are the ones making the promise. You should also be aware of the concept of negotiability. A promissory note is considered a negotiable instrument. This means it can be sold or assigned to other parties. When a bank sells a mortgage on the secondary market to an entity like Fannie Mae, they are transferring the right to receive payments by endorsing the note. This is why you might receive a letter saying your mortgage has been sold and you need to send your checks to a new address. The note is the piece of paper that carries that value and gives the holder the right to collect. The parties involved in a promissory note have specific names that you need to memorize. The borrower who makes the promise is called the maker. The lender who receives the promise is called the payee. Do not confuse these with mortgagor and mortgagee. On the exam, if you see the word maker, think of the person making the payment. If you see the word payee, think of the person being paid. Another frequent point of confusion is the recording process. While mortgages and deeds of trust are recorded in the public records to provide constructive notice of the lien and to establish priority, the promissory note is generally not recorded. It is a private contract between the lender and the borrower. If a question asks which document is recorded to protect the lender's interest in the property, the answer is the mortgage. If it asks which document is the primary evidence of the debt, the answer is the note. You will also see questions about specific clauses within the note. The acceleration clause is one of the most important. This clause gives the lender the right to declare the entire loan balance due and payable immediately if the borrower defaults on a payment. Without this clause, the lender would have to sue the borrower every time a single payment was missed. Another clause often found in the note is the prepayment penalty clause, which imposes a fee if the borrower pays off the loan earlier than scheduled. It is important to remember that these financial terms live in the note because the note is all about the money. To keep this straight for exam day, remember the phrase, "The note is the debt and the mortgage is the threat." This simple shortcut reminds you that the note is the financial obligation, while the mortgage is the legal tool used to take the property if you fail to pay. Always look for the word promise or pay when the question is targeting the promissory note. If the question focuses on the property being pledged or the lien status, switch your focus to the security instrument. Understanding that the note stands on its own as a negotiable piece of paper is the key to passing these finance questions on your real estate exam. By focusing on identifying who is promising to pay and recognizing the note as the core evidence of the loan, you will be well prepared to handle any question regarding real estate financing documents.